There's a lot of fear swirling around the financial world this week after two U.S. banks failed in just the past 6 days. But what exactly is going on here, and what does it mean for you and me? So let's start at the beginning. First, Silicon Valley Bank, a major lender for tech startups, collapsed about a week ago after too many of its customers started withdrawing their money. A couple of days later, another financial institution, the crypto-heavy Signature Bank, failed as well, sending the industry into turmoil. And the instability of it all has taken its toll on the stock market, which has seen losses across the board since news of these failures broke. Now both banks are under federal control, and regulators have pledged to cover all of the institution's deposits, not just the amount they're legally insured for. And the Biden administration, from Treasury Secretary Janet Yellen to the president himself, are trying to reassure the country.
I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses. Look, the bottom line is this: Americans can rest assured that our banking system is safe. Your deposits are safe.
But there is still a lot of mistrust in the system here, and plenty of financial anxiety as inflation continues to raise the cost of everyday necessities like groceries and energy. So what can we do to keep our money safe? And if there is a light at the end of this inflation tunnel, we want to know what it is. Joining me now to discuss this is Ron Lieber, author of the New York Times Your Money column, and Dan Primack. He is a business editor at Axios. Welcome, gentlemen.
Thanks for having us.
So, hi. So, Ron, I want to start with you. I mean, I feel like this is one of those things where folks are just really overwhelmed with the information, folks who don't study the business markets inside and out. And what effect does the failures of SVB and Signature have on the market right now as it stands?
Well, the stock market hasn't moved all of that much in the last 5 days. I was just checking it for a column that I was writing. And so, if you're thinking about the overall investment, which is how most people look at the business world who don't watch it every day, they see what the S&P 500 stock index is doing. That hasn't moved so much. Banking stocks, different story entirely. And when those bank stocks start to move around a lot, people get scared and wonder what's happening with their money at their bank.
And so, Dan, we saw some folks locally here in the Boston area lined up at the few branches of SVB Bank that we have here, and they were taking their money out, very concerned about that. Should folks be worried at this point about their investments?
Investments, maybe. Deposits, no. So SVB, one of the reasons there are even branches in Massachusetts is SVB a couple of years ago bought something called Boston Private, which was this big private bank, which was obviously based here in Massachusetts. And also we have a lot of tech and life sciences startups, and SVB, banks or banked tech and life sciences startups. Look, I understand why people lined up. If you were an individual who had more than $250,000 last Thursday and definitely last Friday morning, there were big questions whether you'd be able to get your money or whether it could disappear. I think those were legitimate questions for people to have. The Federal Reserve and the Treasury came in subsequently on Sunday night, said we are going to cover those deposits, even if you have $20 million in there. All $20 million is basically guaranteed. But look, I think people who are in other banks, there are concerns in certain banks. There's a handful of them, something called First Republic, which has been up and down. It might now have a deal for liquidity today. There's reason for concern, but right now it does look like the Fed and the Treasury are prepared to step in if there is another bank failure.
So should folks be thinking about moving their money around? I mean, and as we talk about the stock market, which we know hasn't moved as much in recent days, folks might be worried about their 401ks.
They might be. I'd say on the money side, if you are an individual who has more than $250,000 in a bank and there is not extra insurance on it, and sometimes there is, particularly in Massachusetts, a lot of community banks have something called DIF, which is insurance on top of the $250. But if you have $500,000 in a bank and that second half isn't insured, yeah, you should probably move it just in general for life. Like, that's a good conservative thing to do. In terms of investments, as Ron said, the market hasn't moved that much. I mean, if you've got a portfolio of bank stocks, that's a bit problematic. And there are rising recession risks. A year ago or 6 months ago, everyone kind of thought we'd have a mild recession in the US in the back half of this year. Then everybody got a lot more bullish, and now there's more questions about it.
Ron, do you think that we could see other banks with a similar, I guess, business practices as the two financial institutions that we've seen? Should we worry about others failing?
Look, it could happen. I try to stay out of the prediction game. But here's what we're seeing today in particular with the regulators sort of nudging a bunch of giant banks to put a bunch of money to work at First Republic to kind of try to shore it up, right? It sure seems like the regulators are going to stop at basically nothing to keep everything from spinning out of control, right? And so what we saw over the weekend was that they were going to step in. They were going to step in not just at the $250,000 sort of guarantee FDIC level, but they were going to guarantee every last dollar, right? So that doesn't guarantee that if there is a bank problem tomorrow or in a week or a month, that they will do the same thing. But politically, it would be pretty hard at this point if a bank anywhere near the size of the ones that have already gone under, if they get in trouble, it would be very difficult politically not to backstop those customers who have that amount of money. But again, talking about, 99% of the people watching here, they don't keep anything close to $250,000 sitting around in a bank account. And for those folks, if their bank happens to go out of business, in a day or two, the FDIC or another bank has taken over and things sort of continue apace.
We know that.
Can I add here, Crystal?
Yeah,
the real
absolutely.
concern is less about individuals and more about businesses keeping money in accounts, right? Because while you might think, well, I don't own a business, but businesses employ people, right? That the bigger concern is less individuals. Obviously, it was individuals lining up outside the branches. It's more if a company has a couple $1 million, has next week or next month's payroll sitting in the bank, that bank were to fail, then what happens? But I agree with Ron. There is the so-called moral hazard thing. It would be almost impossible for the Biden administration to have bailed out a bank called Silicon Valley Bank and then not bail out one in Pittsburgh or Cleveland if it were to go under.
We know that Treasury Secretary Janet Yellen spoke with the Senate Finance Committee today. We want to roll some of that sound and have you respond and react to what she said.
I can reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them. This week's actions demonstrate our resolute commitment to ensure that our financial system remains strong and that depositors' savings remain safe.
Now, Ron, I want to ask you this because we also know that Massachusetts Senator Elizabeth Warren was critical of what has been done, what she called the deregulation of sort of the banking systems. And she flat out said to reporters today that Jerome Powell and others are the reason why Silicon Valley Bank was able to do what they were doing. They were reckless in their investment, according to her. And this is what happened.
Well, look, it's true that regulations loosened a couple of years ago in such a way that a bank precisely the size of Silicon Valley Bank had sort of less oversight and fewer rules. Now, the question of how that might change going forward is a much more complicated one, the political reality and the regulatory reality being what it is. But I think you can make a pretty good case that had we been in a 2015 regulatory environment, in the very least, there might have been more governmental scrutiny of the bank. Now, there were other people in sort of the private sector, analysts who were sounding alarms in the days or weeks beforehand, but they didn't really have a power to force the bank to do anything differently.
Dan, what do you think about this?
Yeah, look, the people in the private sector, some people recognize this. I mean, realize the reason that the SVB spiral starts is because on Wednesday night they announced they're gonna sell a bunch of stock or want to sell a bunch of stock. The only reason they were about to do that is that private sector organizations, particularly a credit rating agency called Moody's, was about to give them a big downgrade. So Moody's had figured this out, and that's the kind of the kickoff of this. It's interesting. It is possible that if the regulations got changed, that maybe some of this would have got caught. But the reality is, and this is something Warren suggested today, asking that Jay Powell recuse himself. Silicon Valley Bank, it's not like it didn't have a regulator. It did. The San Francisco Fed was supposed to be watching for this sort of thing. And there are questions right now as to how did the San Francisco Fed not see what Moody's saw, not see what even certain venture capital firms, and candidly, what the Wall Street Journal even saw in a story a couple of weeks before this all happened.
Yes, and thank you for the correction on the name there. Let's talk about inflation, because I think this is something that's really, folks continue to deal with the effects of inflation and then the corrections for inflation. I'm from a family of realtors, and they certainly felt that when we're talking about mortgage rates and, the price of eggs. Anyone who's, I think is always the example that folks take. Do either of you think that there is relief in sight? And I'll start with you, Ron.
I think it's possible. Look, I mean, the rapid rise in interest rates is what created the problems on the books of Silicon Valley Bank that caused them to do what they had to do. Now, the Fed had been raising interest rates because they thought that that would tamp down inflation. It had worked a little bit, but maybe not as much as they had hoped, at least as the numbers indicate, in recent weeks. So what happens now? They sort of have a choice on their hands, right? They can continue to raise rates, but that has at least some possibility of causing more problems at other banks with similar with similar balance sheets. Or they can put a stop to it. But if they put a stop to it, what's going to happen at that point? If they stop raising rates with their efforts to tamp down inflation, it's a delicate dance, and the circumstances of the last couple of days don't make it any easier. I do not envy them.
Yeah, Dan, do you think you can correct too much?
You mean on the interest rate side? You can. And obviously, people who were shareholders of Silicon Valley Bank, I think today would be saying, yeah, you corrected too much. But I agree with Ron. The Fed is really in a no-win situation here. The Fed already has these dual mandates. One is to keep inflation low, and the other is to keep employment high. And right now, right now they're kind of in conflict with one another. And then this banking thing is this third variable. And in theory, the Federal Reserve shouldn't care about what happens to stocks, but the Fed does have to care about what happens to the banking sector. It's not one of its mandates per se, but it's also a supervisory role. So it has to care, and it's not immune to it. So I think it was pretty clear 2 weeks ago what the Fed was planning to do. Jay Powell said, we're going to keep raising, or basically implied we're going to keep raising rates. I think right now, I wouldn't bet it. I know you can bet on things now in Massachusetts. I wouldn't bet on this.
That's right. So do we anticipate that, with the banks and then now we're talking about possibly having more inflation rates? Like, how would you advise, I guess, someone at home, if you were who are watching, or someone who's in your living room perhaps sharing a glass of wine, how would you advise them? Like, would you say, keep calm, it's all going to work itself out? Or, I'm sure you get a lot of phone calls from folks, asking for financial advice or just ways to ride it out. And Ron, I'll start with you.
It's pretty rare that run for the hills has turned out to be prudent advice in retrospect. This week, I've been going back to all of the stay calm columns I've written in 2008, 2011, 2015, 16, 18, 20. And there wasn't anything embarrassing in any of those. Look, the fact of the matter is, if you're thinking about the markets, right? I just looked at some data this morning. Over the course of 47 years, if you stuck in a U.S. stock market fund, put your money there, just left it. The return is 1,400% over that 47-year period. If you decide to just go to the sidelines, just wait till things get a little more calm, right? And then you'll get back in, right? If you miss the 10 best trading days of those 47 years, your returns drop from 1,400 and change to 600 and change, right? So most of us out there aren't experts. Even the experts generally don't outperform the performance of an overall stock market index. So, if people think that they have to do something, right, I would suggest the following. Like, don't just do something, stand there, take a deep breath, and try to stay the course.
Dan, for folks freaking out, what do you tell them?
I tell them I don't give advice. I say, look, if you've got a good mattress, that's fantastic. Everyone should have a good mattress, maybe with a little slit in it, and just shove little things in there for a rainy day. But I generally agree with Ron. And look, like even with SVB and what we've seen in the past week, people who happen to own stock in that bank or bonds in that bank obviously got wiped out. That's very bad for them if that happened to be where you invested. But if you were a general investor, as Ron said, in a general market index, you haven't really felt this. You felt it if you've been like watching endlessly on your app, because there has been a lot of volatility inside the days. But in the end, you haven't really, the headlines have been bigger than what's happened to your accounts.
All righty. Ron Lieber and Dan Primack, thank you so much for your time.
Thank you.
My pleasure.